Investing with borrowed money can enhance your returns when your investments do well, but debt can also magnify your losses, dramatically increasing your risk. Proper investing is about weighing the risk versus the potential for reward. So does adding borrowed money to your investment portfolio make sense for you? I'll discuss the risk of using leverage coming up next. Someone once told me that you should never invest with your own money. He believed that the key to building wealth was to borrow money from the bank to invest, rather than putting in the work, patience, and discipline necessary to save up money ahead of time. It's easy to see the value in what he's saying by looking at real estate as an example. If you purchased a home for $100,000 and the home's value increased by 10% in 1 year to $110,000, you've made a $10,000 profit. That's a 10% rate of return on your original $100,000 in savings. But with real estate, you could use the $100,000 as a down payment on a much larger home. Using the $100,000 as a 10% down payment, you could take out a $900,000 mortgage, allowing you to purchase a $1 million home. Now, if real estate values increase by the same 10%, your property value increases to $1.1 million. You've made a $100,000 profit. Since your original investment was only $100,000, that's a 100% return on your money. That's the power of using debt. In finance, we call this leverage. Here's the problem. Debt magnifies your returns in the good years, but it also will magnify your losses in the bad years. In the no-debt example, if the value decreases by 10% to $90,000, that's not that big of a loss. If you need the money, you can sell the property for $90,000 in cash. You've only lost $10,000. In the debt example, if the property declines by 10% in value, the home will only be worth $900,000. Now, if you're forced to sell, you still owe the bank $900,000. So you've lost all of your original $100,000 investment. A 10% decline in value is not that big, but because you've utilized debt, you could stand to lose 100% of your original investment. Investing is about weighing the potential reward you will receive against the risk of loss. Using borrowed money increases your risk, simply because no matter how much you win or lose, you will always need to pay the borrowed money back. It's really the difference between investing and gambling. Investing is about putting savings to work for you. Savings is obtained through hard work, patience, and discipline. No matter how confident you are about the outcome of the investment, trying to take a shortcut by using borrowed money turns any strategy into the equivalent of gambling. One of the easiest ways to invest borrowed money is through a brokerage firm offering margin accounts. Before attempting to use margin, you need to completely understand the risk. Here's how it works. If you have $100,000, your broker may extend an offer to loan you money, allowing you to purchase up to $200,000 in stock. This represents a 50% margin. Say you purchase 2,000 shares of a stock valued at $100 per share. Here's the risk. Say the share price of the stock drops by 20% down to $80. Normally, that's not a big deal. If you believe in the stock, you would simply hold on and eventually it will recover. But when you're using margin, you may be forced to make bad decisions. You still owe $100,000 on margin, but your portfolio value has dropped to $160,000. In most brokerage accounts, the maximum margin allowed is 50%. This means the most you can have outstanding is now down to $80,000. The broker now has a right to demand that you bring your account into compliance. They can either force you to deposit an additional $20,000 in cash to pay down your loan balance, or they can force you to sell stock at the worst possible time, realizing losses on a position that is probably only down temporarily. As a rule, you should be very careful investing with borrowed money. Using leverage can magnify gains, but they can also magnify losses. In the case of margin accounts, debt can also force you to sell stock holdings at the worst possible time. Please subscribe to my channel. I'll be releasing more videos weekly covering financial planning, investing, taxes, and insurance. You can also visit my blog at smartzonefinance.com for more financial insights. If you would like to see your financial question answered as an animated video, feel free to leave a comment below.